All right. Well, hello everybody. It's 2 o'clock, and it's time for the Friday's edition of the COPEC Daily Web Show live stream. Uh, Definitely happy to have everybody with us today. Today we've got a special guest, Russ Golowin, and we're going to have a discussion today about the gift tax discussion. And so we'll go ahead and get started here on that shortly. From 2 to 2:30, we're going to have an open discussion about that. And then we'll close out the program, but then we'll stay afterwards from 2:30 till 3 if there's any questions. And happy to have you join us for that as well. The hosts for these programs are myself, Jay Linder, COPEC president and founder, and along with Jerry Snyder, who also was one of the founders of COPEC and acts as our secretary. And happy to be part of this. And we've been doing this for quite a while, since 2004. And I'll get into that in a little bit here. One of the important things that I really need to talk about is some of the disclosures here. All of our speakers are voluntary. We are passionate about giving back to the community in this education format. And so here's some disclosure on not only our speakers, but also potential conflict of interest, affiliation, and retirement strategies. Since we host it, we also own retirement strategies through the affiliation, so there's some disclosure on that as well. So take a few seconds and review this. You can also screenshot it or go to our website, copeceducation.org, and we've got information, the disclosures there as well at the bottom of the screen. All right, great. I wanted to give you a second to go through that. And as far as the actual program, or COPEC actually, it's a 501c3 organization started in 2004 for the purpose of providing professional education in a lot of different areas for the community. No cost, no expectation, product sales, no marketing. And it's really about getting education out there. What you're listening to today is part of what we've discussed regarding the new financial wellness platform. This platform really brings in a lot of financial wellness areas and expertise in these extra programs that we're doing. And so I'll walk through that in a second as far as what that's made up of, but today is one of those, including legal and estate planning and things of that nature. The program and technology. Obviously, we have times where we might have a connectivity issue. Just be patient and stay on, and we'll make sure we get that up and running as fast as possible. We haven't had any challenges yet, but it's bound to happen at some point. And again, if you have questions, just send those through the Q&A, and we'll answer those as best we can, not only during the program, but definitely afterwards from 2:30 to 3. Holidays, we do not intend on having these programs on the major holidays, and also things like the day after Thanksgiving or the day before Christmas, Christmas Eve. So be aware of those, and then share this with others. This is great information. We really want to make sure that we get this out to everybody as much as possible, and share it with whoever you think might be benefit from this. So we'll keep these going, and hopefully we'll be able to assist many people with some of that basic education information. As you can see on the right side, that's a list of a lot of the different presenters that we have. And so different ones will be doing different days and topics, including the Financial Wellness Fridays that you'll see coming up here in a little bit. And so when you go to the website, for those that have gone to the portal, the first top left tile is today's daily show. And that's down below. I really want you to focus on those different calendars, August, September, October. of 2019. Take a look at those and review all the different topics and see the ones that really, pop out at you that might be of interest, and make sure that you attend those programs. Many of those also be part of those Financial Wellness Fridays. And this is an example of those calendars. So you can see down there on the bottom right, we're doing the 21st legal gift tax discussion. And so this should be pretty accurate. There might be some changes from time to time, but in general, this should be pretty good. And then in the middle there, 2 or 3 times a year, we do a special program that is specific to one of the biggest goals financially that people have, which is preparing for retirement and that transition. This is a great program. This is the only one that really we need registration for because it's real important that some of these are in person for space and those types of things. Still no cost, still no marketing, just so that we know how many people will be there. Today's program and Financial Wellness Fridays does not need registration at all. And then Financial Wellness Fridays, you notice down there on the bottom, we just had today the Medicare Basics. Jerry Snyder did that at 11 o'clock. And pay attention to those, just like the Daily Show. The difference here is it's more of a full 1-hour lecture. And so for those that listen in, there won't be as much interaction, Q&A, things like that. But feel free to log into those. And those have had great attendance so far. But a little bit less of the back and forth discussion conversation. And then here, if you're part of a department, let's say you're down at the university and you've got a department or another company, and you've got employees or associates or members that you'd like to actually have a program specific for you, we can do that. We've been doing that all along for the last, nearly 16 years. And just send me a note. And we'll take a look at that, see what we can set up for you. And there you can see in the bottom, there's a lot of different program topics, if it's things you've seen in the Financial Wellness Fridays or others, but we can set that up and just let us know. And then lastly, you notice the 15-minute consultation. Because these are open kind of to everybody, a lot of times we have people that have private information that they really are not comfortable sharing, or they want a little bit more of a one-on-one conversation. This is great to do that. Again, there's still not any marketing, sales, or promotion, but it's a good opportunity to bring out, maybe you're going through a life event, maybe you've got a special concern that you really need some attention to. Just set that up and we'll walk through that with you and give you some guidance. So with no further ado, we'll go ahead and start the program and the discussion here with Russ. And Russ, thank you so much for joining us today. This has really been a lot of fun having you integrate with the financial portal, and you really deal with a lot of areas that a lot of our attendees focus on. So if you could take just a minute or so, give a little bit about yourself, and then also what we're going to be talking about today.
Sure. Thank you, Jay. As you can see on the screen, my name is Russ Golowin. I am an estate planning and elder law attorney. And what that means basically is I do wills, trusts, probate, help people if they're going into nursing homes or assisted living, try to organize, protect their assets, make sure everything avoids court, stays private, help everything go easily and smoothly. Today, we're going to be talking about gift taxes, which isn't necessarily a huge part of what I do on a day-to-day basis, but I find that many people don't understand anything at all about when they have to file a gift tax return, how much they might have to pay, and all those basics. So today is really for a person that just has always wondered, what is gift tax and how does it apply to my life?
Well, great. And again, we're going to have a great conversation here. And, the first question I have is, when is a gift tax really required? I mean, you always hear about this in different situations, and especially maybe what was common, in the 80s or 90s versus what might be common today. When are they really required and for who?
Right. Well, that's the biggest question of all. And what we have are people that if they give their child a little bit of money to help them buy a car or pay for tuition or something like that, everyone's worried about if they're going to get hammered with tax, or does the person receiving it have to pay tax? And so it can become really confusing. The best example I can give, where if you were to remember this, I think you'd be in the right ballpark, is if I was giving this presentation to a room of 100 people, I could give everybody in that room $15,000 cash, which of course I'm not offering to do, but if I could do it,
I thought that was part of the program today.
Right. Then we'd have many, many attendees, right?
Yeah, right.
So if I could give all of you on the call $15,000 each, I could do that. I would not have to pay a gift tax return at the end of the year. I would not pay tax, and the person that got the money would pay tax. There's a nothing. It's a free $15,000 gift that the IRS lets you give to any individual in any calendar year. So I can give 15,000 to 10 people in 2020. I can give 15,000 to one person. I don't even have to file a gift tax return. When I have to file is when I give somebody $15,001 or more in a calendar year. At that point, I have to file that 709, that's the gift tax return. And I have to report that not only did I give my 15,000 freebie, but I also gave some extra, whether it's $1 or $10,000. I need to tell the IRS that, and then they keep a little logbook on me that says, hey, Russ Golowin, he gave away $10,000 extra in 2020 when he gave his aunt $25,000. So if Russ dies and he's over the lifetime exclusion of gifts, he's going to have to pay estate tax. Or if I give more than a certain number in my life in gifts of above the 15,000, I will then have to pay gift tax. But before I get into those details, what I really want people to remember is, number one, you can give 15,000 with no impact at all, no filing requirement. If you give more than 15,000 in a year, you are supposed to file, but you probably will never pay gift tax during your life unless you're a multi-millionaire. So does that kind of clear up when you should file, Jay?
Yeah, and what about like if you got two spouses together, how does that work? You know.
Oh, right. Yeah, so a married couple, I can give a person 15,000. My wife can give a person 15,000. So what that means is we could give one individual $30,000 without any negative gift tax reporting on either of us. All we have to do, though, is we do have to file that return and tell the IRS we're doing what they call gift splitting, where we're both giving $15,000 to that individual in a year. Again, no tax to pay, no negative impact down the road. We just have to let the IRS know we did it by filing that gift tax return April 14th of the year after the gift. So that'd be 2021 in our example.
Okay. Hey, I've got a question because I know some of the tax laws have changed over time, and the limit what you're required now versus back in 1985 or something like that. If you're building up those credits, but the laws change, do they typically grandfather those? Or does a lot of what legislature changes, do they typically reserve that, or is it usually lost? Based on, I mean, obviously, who knows?
Right. Well, for an example, I think it was 2000, the year 2000, I think, now we're talking about two different types of taxes because they work together, but there's gift tax and there's estate tax. In 2000, the estate tax limit, which is the amount that you could die with before there was any taxation, estate tax, I think it was 600,000. And so if I died and I had a house worth 500,000 and a life insurance policy worth 500,000, when I died, I would have $1 million according to the IRS. And so the excess of that 600,000 would have faced an estate tax of something like 50%. So that would mean I had 400,000 over the 600, and 50% of that faced estate tax. So my estate would have to pay 200,000 in estate taxes, which of course was an incredible amount. Now, an individual, when they die, can have $11.58 million before that same estate tax hits. And that's also the amount that you're allowed to give over your lifetime of above that $15,000 per year. So the reason the IRS wants those gift tax returns filed is so they can see, has Russ given away his whole 11.58 million? And if I have when I died, then any assets I have are going to face estate tax. Now, of course, that doesn't apply to many people at all. So estate taxes are not a concern for many, many people. But the law could change, like you're saying, Jay. It could go down. And so if they move that 11.58 all the way back down to 600,000, my opinion is there wouldn't be any grandfathering. It would just be, what is the law on the day you died? And so one reason to make sure you filed your gift tax returns over and above the fact that you're required to is just to make sure you documented what you did, so that there's no trouble and no problem trying to recreate or find that information from, could be 20, 30, 40 years ago.
Right. Can you walk through an example maybe of the most common situation that a normal person might come across, a gift tax return type scenario?
Sure. 15,000 is a pretty decent amount of money, but one example, it could be paying tuition for a grandchild, something like that. You're retired, you're financially independent, you have the money to pay whatever it is, $40,000 for your granddaughter's annual tuition. You should file a gift tax return saying that, yes, I gave her more than $15,000 in a year. Again, I won't have to pay gift tax unless I've already given away over $11 million, but it is required, and so that should be done. Another time, and I'll mention this a little bit later, but Medicaid situations, sometimes people, when they're facing a potential long-term care stay, assisted living or nursing home, they have to get rid of some of their money by either spending it on care or making transfers. Sometimes people will create an irrevocable trust and transfer that money there to get it protected. But sometimes the question becomes, well, did you really give it away? Or is this just some sort of where you're trying to hide money and it's not actually a transfer? Well, if these things are done right, they are a true transfer. You're not hiding anything. And so you would want to make sure to file that gift tax return to let the IRS and everybody else know this is a true relinquishment of control. I am transferring it to the trust. It's no longer mine. And that way, you just stay out of trouble later if anybody tries to claim that this wasn't a true gift and that money should still be counted against your eligibility for long-term care. So those are a couple examples of where it might come up.
Does the receiver of the gift, do they have to file anything? Is there anything put on them? Do they have to pay taxes or record anything?
Yeah, that's a really good question. I was always confused by that also, because it feels like if you get money for free, that the IRS is going to want some tax, right? It feels like that since we're taxed on so many other things. But no, the person that receives a gift does not have to pay tax. They don't have to file a gift tax return. It's only the person that gives the money that has to file the return and may have to pay tax. Again, only if they've given away a whole bunch of money during their life. So usually gifts over $15,000, the only thing that has to be done is to file the return. There's no tax being paid in the vast majority of gift transactions.
Now, being that I'm a financial advisor, sometimes we work together regarding what is a good thing to gift, right? So you talked about that gift. Maybe it's property, maybe it's a stock, maybe it's cash. What would you recommend somebody consider when they are giving something that what do they lose? What could they potentially lose while giving this from different types of equity, whether
Right.
it's stocks, property, cash, whatever it might be?
Yeah, I mean, I think it's a good idea if you're not really feeling knowledgeable about this to get some financial advice from a tax professional, financial advisor, whatever the case may be, or perhaps an attorney. But what happens a lot of times, well, I'll give you a couple different examples. Number one, just before I forget to mention it, a lot of times people come in and they say, well, yeah, I want to put my son's name on the deed to the house or to the farm or some sort of real property. And I'll say, well, okay, well, what do you mean put his name on the deed? And sometimes people don't really know what that means. They just heard it was a good idea. And so I'll say, okay, well, just so we're clear, you want to give half an interest in your farm or your house to your son. And usually they'll say, well, no, I don't want to give him anything. I just want to put his name on the deed. So right there, we have to clear up. Putting someone's name on the deed is giving them half.
Right.
If it's two people that are going to be on the deed. So that is a gift, and there should be a gift tax return filed if the interest is worth more than $15,000. Okay, so that's one thing just to be aware of. But in general, to answer your question, the other issue is before making a gift to somebody, consider the tax impact, not gift tax, income tax. Because if I have $50,000 cash in the bank and I give my son the $50,000, well then again, I have to file a gift tax return, but there's not going to be any gift tax to pay, and there's no income tax that my son has to pay. But if I have $50,000 in stock and I bought that stock way back when for $1, right? And it grew 49,999. If I give that stock to my son, well, when he sells it, he's going to take my tax basis, which is $1, the amount I bought it for. So when he sells it, he's going to have recognized about $50,000 in taxable gain. So he will have tax to pay of, several $1,000s, well, probably 20% or so, I think. And so he's not going to get 50,000. He's going to get less than that. If instead I let him inherit that stock when I die, he takes a stepped up basis of whatever it was worth when I died. So if it was worth 50 when I died and he sells it for 50,000, there's not going to be any gain and he won't have to pay any tax. So some cases you would much rather inherit property, especially property that has appreciated in value, rather than giving it away during life. And unfortunately, I see people when they get ill or when they just reach an advanced age, they start giving away without really thinking through the income tax ramifications of that. So think about it or get some guidance before transferring property, especially if it's appreciated in value over time.
What if somebody forgets to file a gift tax return? What happens?
Yeah. Well, I think that's probably pretty common. There is a penalty, just like if you forget to file or forget to pay your income taxes. I think the penalty for gift tax is 5% a month, up to a maximum of 25%. But that's when there was a tax due. There, again, unless you've given away millions of dollars, you probably aren't going to have a gift tax due. But I believe that there's a fine of a couple $100 if it's ever discovered that you should have filed a gift tax return in a particular year and you didn't. So, I mean, you are required. That penalty is not huge if there's no tax due, but it's definitely best to get those filed appropriately when due.
And what does it typically cost somebody, either on their own or through an attorney or through a group to have those done? What are they looking at typically to have those papers drawn up?
Yeah, I mean, my experience is that the different places I've seen might charge $200. If it's more complex for some reason, maybe $300. But I don't think most of the time they're considered to be that complex or that time consuming. So I think you'd probably find it to be in the range of somewhere within that range.
Kind of running out of time here, but I think maybe we can start this now and then take a pause and go into the second here. But I would imagine that gifting happens a lot when you deal with Medicaid. I know that you talked a little bit about this before.
Right.
Do you want to expand on that a little bit more?
Yeah, I probably should have expanded on that back with my initial example, but this is really a big deal. We live our whole life thinking about this $15,000 rule, how we get a free gift of whoever we want per
Right.
year of $15,000. The problem is if we ever do need in-home assisted living or nursing home care, and we're trying to apply for Medicaid, suddenly the rule is totally different because there's the IRS rules and there's the Medicaid rules, and they're not always the same. So Medicaid says, we don't care if the IRS gives you a free $15,000 gift. We Medicaid say, if you gave away $15,000 in the last 5 years, we're going to count that against you, and we're going to make you ineligible for Medicaid for a period of time, which would be something like 2.5 months if you gave away $15,000. If you gave away $15,000 a year for 4 years, that's $60,000. That would be an ineligibility period of almost 9 months. So gifting is a problem for Medicaid. It's not, there's no free gifting rules. So if you or someone you care about is maybe starting to decline, you're worried about a potential need for Medicaid for long-term care, they might consider stopping making the gifts that they've been making, or at least incorporate that into whatever planning they're doing so that they're not caught by surprise later.
So again, to clarify, the gift tax is for estate planning from the IRS.
Right.
Medicaid, the gifting rules there, they don't care what the IRS is allowing you for free each year. They don't care about any of that.
That's
They
right.
apply it fully from $1 on gifting.
Right. That's absolutely right. And, there are other similar Medicaid rules, such as, if you have $20,000 in an annuity, but there's a surrender penalty of $5,000, for example, Medicaid doesn't say, oh, well, we don't want you to have to pay that surrender penalty. They just say, okay, surrender it, get the money out, and spend it.
Right.
So they are not complementary rules in that example. There's just IRS and there's Medicaid, just like you said.
Right.
Yeah.
Hey, we're at 2:30. We're going to go ahead and stay after, but we need to, for library purposes, take a pause here. Thank you so much for joining us. For those attendees that are on, please go ahead and submit your questions, and we'll go ahead and spend as much time as possible going through any questions you have. Those questions can obviously be for Russ specifically on today's topic, or if you've been having other questions that came up with other topics that we can try to address, we can do that as well. Russ, do you want to go ahead and maybe just spend 30 seconds, wrap this up, and give us kind of an overview takeaway?
Sure. Yeah, I just wrote down 3 key points for everyone. Number 1, remember, you can give away to each individual $15,000 a year. Don't have to even file a return. If you give away more than 15, you're going to want to file that gift tax return. Number 2, it's not an issue of usually paying tax. It's just your obligation to file. And number 3, for Medicaid, for long-term care, remember there's no free gifts. So make sure you plan ahead and consider that if you're looking for a nursing home or assisted living type care paid by Medicaid. That's all I have for today, Jay.
Well, that's great information. I was going to try to share your information again. If anybody has any questions specifically for Russ, his information's there. Don't hesitate reaching out and getting his expertise. He is very giving of his time for those that have those questions. And Russ, thank you so much for doing that. We'll go ahead and take a brief pause here, and we'll continue with any questions. So thank you so much for joining us. Russ, thanks for being here, and we'll definitely be talking with you next week as well.
Sounds good. Thank you, everyone.
Thank you.